From Deloitte Tax, welcome to the Tax News and Views podcast. In this podcast series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. Today, we're going to discuss the Superfund Excise Tax, which is a new tax on the manufacture of certain chemicals, as well as those that import certain chemicals. If the name Superfund Excise Tax sounds familiar to you, there was a similarly named tax back in the 80s. But this is a new tax with a new set of rules that was passed in late summer of 2021 as part of the bipartisan infrastructure bill. Organizations that are subject to the tax need to start reporting in July of 2022. And there are a number of things those organizations need to understand in order to be compliant with those rules. To discuss these requirements, we are joined by two Deloitte specialists in the Superfund Excise Tax area. That is Sarah Beth Smith and Christina Gong. Sarah Beth and Christina, welcome to the podcast.
Thank you, Carrie, for having us here.
Sarah, I'll start with you. Maybe you can tell me a little bit more about what the Superfund Excise Tax is and how it's different from the tax in the 1980s.
Sure. So this tax, it really had its history in the late 1970s as the EPA and Congress worked to structure a large environmental bill with the purpose of identifying hazardous waste sites and then identify the party that was responsible for the cleanup of the sites. CERCLA was the bill that codified these efforts and designated these hazardous waste sites, what is now known as Superfund sites, around the country. Now, the bill authorized Superfund cleanup responses with the intent to designate responsible parties to initiate the cleanup efforts. And in those situations where an owner could not be identified, the intent was to finance these cleanups using funds from the Superfund Trust Fund. And therefore, CERCLA enacted these Superfund excise taxes on chemicals to finance this trust fund to help with those cleanup efforts. The original list of taxable chemicals was determined after Congress identified those chemicals that were found within these hazardous waste sites. And you'll notice that these tax rates on the different chemicals range considerably, and this is due to what Congress and the EPA determined were located in these hazardous waste sites. So that's how we arrive at rates that range from about 40 cents per ton for potassium hydroxide to almost $10 per ton for toluene. And this tax was originally structured to be imposed at the beginning of the commercial chain of production. And as a result, the tax is imposed on the first use or the first sale by the importer or the manufacturer. And this tax did start in 1980 and continued about 10 years until Congress realized that companies that are importing substances, such as polypropylene, were receiving an unfair advantage upon import. For example, if a company was purchasing polypropylene domestically, that company would have paid excise tax on propylene, which is a listed chemical that is included in the polypropylene. However, a company that imported the polypropylene at the time was not paying any tax. And as a result, Congress expanded this original list to include 50 more chemical substances, with the tax to be imposed on the first use or the first sale by the importer of record. Between 1990 and 1995, this list grew to more than 150 substances. So by the time the tax expired in 1995, there were a total of 200 chemicals and chemical substances subject to the tax. The infrastructure bill revitalized the Superfund excise taxes and does become effective July 1st, 2022, doubling the rates of tax from the last time this was in effect in the 1980s, 1990s. Given that this full list of chemical substances now includes 150 substances, taxpayers across the country are having to grapple with this tax and determine how it might impact their business. The number of chemicals at issue, as well as the increased global operations for many manufacturing companies and others in different industries, means that more companies will be impacted than they were in the 1980s. The infrastructure bill also lowered the threshold as to what could be considered a taxable chemical substance, which means we're likely to see more substances added to this list as time goes on. There's currently no assigned rates for the chemical substances, which poses another complexity for taxpayers who are tasked with reporting this tax. Now, there are a few exemptions that companies can take into consideration, including the export of chemicals, as well as a few other exempt opportunities there.
So 150 chemicals are subject to this tax. What types of industries would be affected, do you think?
Now, the list of chemicals and chemical substances is now so broad that many different industries can be impacted, including the common targets of this tax, which were the chemical and petrochemical industries and the refineries. But now many other industries are seeing impacts, including pharmaceuticals, plastics, heavy manufacturing, paints, coating, and even cosmetics, among others.
So very broad, potentially. What is our advice for a company to get their arms around the tax? And then once you know that the tax applies to you, what are your next steps as a tax leader?
The first step is really to contact your operations team, your procurement team, your IT or your trade compliance team, and sit down with them and see whether your company is one, manufacturing any of the listed chemicals, two, importing any of the chemicals or the listed substances, or three, exporting any of those chemicals or chemical substances. And once you gain that knowledge of the individual chemicals at issue, you'll also need to determine the different process flows at issue. Is your company purchasing any domestically and then selling the chemicals, which could then be used in an exempt manner? Are your systems set up to account for and track the different chemicals in business scenarios? The tax does require careful tracking to be able to stay compliant. And there are a number of different scenarios that could impact a company that has these types of process flows. For example, company A imports chromium, then uses the chromium to produce ferrochromium, then sells this ferrochromium. This example hits a number of different pieces of the tax, including imports, production, and sales. So company A needs to be able to track the amount of imported chromium, consumed chromium, and the tax included in the sale of ferrochromium. In another situation, company B produces chlorine, then uses the chlorine to produce polyvinyl chloride, part of which it exports. Now, company B will need to track that produced chlorine, the amount of chlorine consumed in the production of that PVC, and the amount that's then exported. Now, every scenario does have a little bit of different tracking and reporting obligations that taxpayers will need to consider to stay compliant. The specifics concerning some of those reporting are still forthcoming, but it's important for companies to get their arms around the tax as the deadline is fast approaching for day one on July 1st.
All right. Well, maybe now it's a good time to turn to Christina. And it sounds like there is a lot to get ready from a systems and data perspective to be able to comply with these rules. Maybe you can talk a little bit about that and any opportunities maybe to automate the compliance process.
Sure, Carrie. So while working with the industry currently, we do see companies are challenged in several areas to be compliant with these new requirements, that including how to determine taxable product and assign tax rates. As Sarah Beth mentioned, the tax rate is imposed at a very granular level. It ranges from 40 cents per ton to $9 per ton, depends on the different type of products. It is crucial to determine the taxable product and identify an approach to assign the proper rate to each of the material and products the company manages. That could include studying the bond and chemical composition of each of the material in order to assess the right tax rate. Because it is an excise tax, the burden of the tax is on the manufacturer. Companies not necessarily acting as the collecting agent as this manner. So it's important to make sure including tax as part of the inventory cost in order to get the margin report correctly and eventually recover through sales to customers. We suggest companies to start identifying the source system to capture the transactions and master data for applicable transactions, assess what are the data requirements, what data elements are required to be captured, and how to obtain necessary report to support compliance filing.
I can imagine it will be a challenge for tax departments who are used to dealing in dollar and cents, and now they need to understand tonnage of chemical use and how it gets used in their manufacturing processes. It sounds like it could be quite challenging, and there could be a number of data gaps that will need to be addressed in order for companies to comply. I guess any final advice to companies that might be impacted?
Yeah, we will say July 1st is really just around the corner. So it's really important to start prepare now if you haven't. It takes time to implement any process and system changes. As Carrie, you just mentioned, it's quite challenging to manage a new type of tax, especially its volume metrics, different than the traditional value metrics. It will require some customization within the existing system and ERP to capture and apply the tax, to define approach and assign the tax rate on more than 100 plus different products. So it's very critical for companies to start engaging the conversation with your procurement, supply, and IT team, and identify and assess your exposure and the potential gap in data gathering, and define approach so you can calculate tax liability and also accrue and automate it in the system.
This tax does require registration with the IRS in certain scenarios, including inventory exchanges and sales of hydrocarbon streams. Those registrations should be submitted prior to July 1st as part of this day one readiness so that the IRS has these applications in hand once the tax becomes effective.
Well, thank you, Sarah and Christina, for the great explanation. There certainly is a lot for tax departments to focus on. First, just understanding whether or not they're subject to the tax, which means understanding the chemicals they're using in and manufacturing in their business processes, and then getting the data to meet their compliance obligations. Certainly a new area for many who weren't practicing tax since 1995. For listeners, if you'd like to get additional detail, there is an article on this topic. If you search Deloitte.com and search on Superfund Excise Tax, you can find that article. Also, feel free to connect with Sarah Beth and Christina on LinkedIn. They'd be glad to answer any questions you have that way. And in the meantime, we hope you continue to explore our collection of tax news and views podcasts. And we hope you join us as well on upcoming episodes. Thank you all for joining. Continue to be well.